question on my mind is, where's the stock market going to go from here? We saw August, September, October, generally speaking, a decline in the market. The month of November, the market rallied, or at least it came back. I'll say it was definitely an upward direction. Where do we go for December? Where do we go for 2024? That's kind of a thought that's on my mind. Maybe it's on yours. So I want to play some clips, some perspectives, and let you get your own thoughts together. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is November 28th, 2023. I'm going to begin with a piece I want to play for you with Scott Wapner and Liz Ann Sonders. Liz Ann Sonders is the Managing Director and Chief Investment Strategist for Charles Schwab and Company, and she paints the picture, makes the case for the fact that we are not in a new bull market. This is not a new bull run. What happened during the month of November is we had an acceleration on stocks, and it came out of a period of decline prior, leading up through October, and left a lot of people feeling more optimistic. And so the question is, through December and beyond, are we in a new bull market or not? So she unpacks that. She deals with the issues of the fact that really we've got the Magnificent Seven, the big tech stocks, and the rest of the market, small cap stocks that have not participated. And it is just, generally speaking, not a broad market. It's a concentrated market, mostly in 7 stocks. So take a listen to Liz Ann Sonders.
In tech. So what's in store for the new year? Let's bring in Liz Ann Sonders now, Schwab's Chief Investment Strategist. Good to see you. Welcome back.
Thanks, Scott. Happy Thanksgiving.
Yes, and the same to you. I'm sorry that I missed you as well at Impact, but...
Yeah, ditto.
Do it next year.
That nasty COVID thing.
Yeah, well, it's good to have you back. So
thank you.
Let me ask you this. I'm looking at the notes, and you say that it doesn't yet look like a durable new bull market. That says to me you're not a believer in what's happening in the market right now in terms of this rally, and why not?
Well, first of all, as we know, this year has been dominated by the Magnificent Seven. So if you look under the surface, you look at equal weight, you look at the S&P 493, you look at small caps. I actually think the leadership there, or lack thereof, is reflective of all the uncertainties we talk about with regard to Fed policy and where the economy is. It's just in cap-weighted indexes, they're biased on the upside. But there was lots of analysis done by us and everybody else at the point where we hit the 1-year mark in the move from the S&P low now 14 months ago or 13 months ago, and the absence of participation by small caps, by banks, and weak breadth statistics just said that there was still something lacking. That doesn't mean that the indexes have to retest prior lows. I think we can kind of muddle through, but I think for a sustainable move, I think you need to see a broadening out. And I do think there is a lot of money itching to move into areas other than those mega cap names, and that may be where the opportunity sits next year.
So the bottom line is that until you get those other stocks to do anything in a meaningful and sustainable, probably the best way of saying it, a sustainable way, it's just not, you can't say we're good. You just can't yet say we're good.
You could just say that the market is incredibly concentrated and performance is driven by a very small handful of names. That's not in and of itself an imminent risk for the market. That often happens with cap-weighted indexes where you get performance bias up the cap spectrum. It's when you've got dramatic underperformance by the remainder of stocks. Now, it's not as bad as it was at the beginning of June when you had a record low percentage of the S&P at that time outperforming the index itself over the prior 3 months, over the prior 6 months. That's improved a little bit, but I think broader participation, more soldiers on the front line, so to speak, as unpopular maybe as battlefront analogies are, I think would be a sign of a more sustainable rally, especially if financials and banks in particular can start to play some catch up.
Now I'm going to play a piece from CNBC, and they're doing an interview with Tim Seymour and Citibank's Stuart Kaiser. And they're making the case for the fact that the market is going up through the month of December, and that we're going to finish the year stronger than we are today. So as I listened to their words, I realized that there was a fair amount of caution in what they said. They didn't make a definitive statement. So, and by the way, when somebody says, hey, I think the market's going to do this or going to do that, sometimes I look at all information with a degree of skepticism. So I look at predictions like this of, okay, from particularly pundits, they're smart, they're well-read, but it's an opinion. They don't know. And so sometimes I look at it and go, I'm not sure. It may go up. I hope it does go up. But a lot of times I'm very skeptical, which is the reason why that I manage money mathematically and not based on my hunches, because I know that the batting average would not be as good. So take a listen to Tim Seymour and Stuart Kaiser.
And we start off with what is turning into a November to remember. Major markets all on pace to log their best month of the year, with the Nasdaq up more than 11% so far. The biggest winners to date, tech, communication services, and consumer discretionary stocks all up double digits in November. The moves coming amid a sharp decline in rates. The yield on the 10-year dropping from 4.8% at the start of the month to 4.4% now. The benchmark seeing its biggest monthly basis point drop since 2019. So do these trends continue through year end, or are tides set to turn after the holiday? The holiday meaning gobble gobble day, turkey day, tomorrow. Tim.
Well, a trend for yields, also one of the highest moves higher in yields the month before. But yeah, I mean, lower yields mean lower risk, at least they have for the market. And if you look at the VIX, the first place I would start is just say VIX is now below 13, and it's down 44% in 20 sessions, where equities are up almost 12%. You outlined how great a month it's been. The semiconductor space, which has had some extraordinary runs over time, has had its best month ever. And that's crazy when you think about it. And what it tells me also is, as great as this is, we've had an incredible run, and there may be some complacency again. I don't know if this is bullish. I'm not bearish, but I do think you have a case where the market hasn't really widened out. There isn't a lot of breadth. There's a lot of concentrated trades that are crowded that I think a lot of folks into year end are chasing. So I think we can go higher, but I don't love the setup here. It's been such a great run.
There are mixed signals too. I mean, you highlighted semiconductors, which had an extraordinary run, but that cyclical sector's move is not being confirmed by commodities, for instance, Stuart.
Yeah, I think that's right. Look, our view is you're going to be higher into year end. We do expect the leadership of the year to kind of lead us into the end of the close of the year as well. Don't expect PMs to take a whole lot of risk outside of what's worked, this late in the year. And look, if you look at it, lower yields, tighter credit spreads, lower oil, that's all equity positive. It has been narrow leadership, but our view is that narrow leadership is for a reason. The stocks that have won this year are the stocks that are generating earnings. So when you link it back to fundamentals, I think it becomes a little less scary. So yeah, I mean, our view is continue to move higher into year-end. Seasonals are strong. Hopefully we get what we expect out of a solid jobs number, decent CPI print, Fed on hold, and markets and leadership work into year-end.
I've played many times pieces from Art Cashin, a Wall Street legend, and so I'm going to play another one. Carl Quintanilla is doing an interview with him, and he says, where do you think the market's going to go from here? And he says, for the month of December, he's pretty optimistic that it's probably going to go up. But if you listen to his words, he says he's some caution in there. A lot of it has to do with the yield on the 10-year Treasury. He says if it goes above, the yield goes above 455, then it's probably not going to be good for the market. So we'll see. But that, I'd say he believes optimistically, with a word of caution centered around the 10-year Treasury. Take a listen to Art Cashin and Carl Quintanilla.
I think it was FactSet this morning said the market right now, at least, is devoid of any meaningful catalysts. When does that change?
Well, it's very difficult. This season of the year with the holidays and whatever, Sarah mentioned earlier the Santa Claus rally. Years ago, the Santa Claus rally began after Christmas, and then each year it got pulled forward by the gurus and the pundits, and now we're talking right after Thanksgiving that the Santa Claus rally is looming. it's a little bit early for it in a more short-term perspective. Today, I think we've got a tug of war between short-term seasonality, and that is a mild upward bias for the day after Thanksgiving, and the fact that the yields are inching up higher. So that's pulling against the bulls, and the seasonality or the cyclicality are giving them a boost. So we'll see who wins out. I always favor the cyclicality. You know, they talk about things like muscle memory, and it goes on. And then we have all these mysteries to look at. You get the open AI with nobody on the board claiming any resolution. Many of the guys on the floor think that maybe it was the artificial intelligence itself. When asked what should we do with the company, they said fire the chairman, and that's how that wound up. Otherwise, it doesn't seem to be an explanation for it.
Yeah, it's a curious one, Art. So you always say watch yields, and that's been the story. We've seen this big move lower in yields on expectation that the Fed is done raising rates. The next move is going to be a cut. The market's going to get excited about a cut. I do wonder if there's a risk here that the market's too excited. If the Fed officials start to push back on that in the coming weeks, if we start to get inflationary numbers that aren't showing enough progress down to 2%. Or do you think this time is different? Because in the past, in the battle between the Fed and the market, in this cycle, the Fed has been right.
No, well, I think that the Fed officials don't necessarily want to play Grinch, but they are being bothered by the fact that the market is getting more optimistic. The market observers are saying things like, well, you know, they're pretty well done. You see that in the projection of expectations. So it's there. I would be a little careful here. I would watch that yield on the 10-year. If it starts to move up above 4.5, above, say, 455, then that will raise a question as to whether you're going to have maybe an attempt to check out the former highs, not all the way up to 5%, a little too early for that. But if you start to move above 4.55, I think you get a little rethink, not only from the bonds, but they may put a little mild pressure on equities. So I would watch that. We may get another retest of the higher level in yields while all that Fed jabber is going on.
Well, I hope you had a good Thanksgiving, and thank you for watching. And I saw this. I thought I would show it to you. Mom, are we in the stock market? No. It's all we can do to be in the supermarket. So with that, thank you for watching. If you have questions or comments, leave them in the comment section below.